Hello and welcome back to the channel. Today we are going to be explaining some economic terms, what they mean, and why they're important. The terms we'll be discussing today are some of the most widely used in economics. They include GDP, PPP, imports and exports, FDI, FX, returns, and unemployment. As always, if you enjoy today's content, please do hit that like button and subscribe to the channel. It would mean the world to us and help us out a lot. If you have any questions, please place those in the comments. And if you have any requests for other topics, please put those in the comments as well. The first and perhaps most widely used metric in economics is GDP, or gross domestic product. This is a measure of the output of an economy. It is the total value of goods and services produced in that economy. It is usually listed in a currency, and it can be used to compare the size of one economy to another, which is why it is such a crucial metric for economics. The next term is purchasing power parity, or PPP. This is a measurement that takes all things equal. It puts them into the terms of the same currency, and it measures the same, what they call basket of goods, or essentially a grouping of how much does bread cost in one nation and in what currency, and how much does it cost in a different nation in a different currency. And it puts those things all equal against each other to be able to make comparisons across different currencies. It lets you go apples to apples, so you can compare China versus the US and the cost of living in different countries. One of the next most widely discussed topics in economics is imports and exports. Imports are any goods or services that are brought into a country. Exports are any goods or services that are sold outside of a country. It's used to show how reliant on selling or buying some countries might be, and it also gives an indication as to how reliant that country is on producing its own goods and services and utilizing them within the country rather than selling or buying them elsewhere. So it's a very important measure within economics. The next important term is FDI, or foreign direct investment. This is a measure of how much money is being either invested into the country or people inside the country are investing outside the country. FDI inflow is when outside investors invest inside the country. So say someone from the United States invests in Russia, that would be FDI inflow to Russia. Outflow is the exact opposite. That is when investors inside a country choose to invest inside a different country. Say investors in the United States choose to invest in China, that would be FDI outflow from the United States. It's used to show stability, expected performance, and returns within a nation. So if a country is receiving a lot of outside investments, that's a very good sign that investors either view it as stable if they come from a less stable area, or they view their likelihood of getting a good return as high. So it's a very important metric within economics. Foreign exchange, or FX, is another very important metric. This is how much of one currency buys another. For example, 131 Japanese yen buys 1 US dollar. This is used to show the strength of one currency or economy versus another. It can also show relative costs for those economies. This is an important measure in economics, as we like to view the relative strength of one currency versus another to determine and interpret how strong or weak those economies might be compared to one another. Stock market return is another important financial concept. This is a measure of how much the value of the stocks and bonds inside a country move up or down. It is different by each nation, as each one has its own national stock markets, and it can be used to compare the markets of one country to another. It shows how volatile they are and the relative strength of their market. You can compare the ups and downs of each one against each other and see which one is more volatile. It's important to look at this, as this has a large impact on how money flows throughout the financial system of the world. The last major metric we're looking at today is unemployment. This is a measure of the number of job seekers actively looking for work. So these are unemployed individuals looking for a job that currently do not have a job within the country. It shows how competitive the labor market is. For example, a 6% unemployment rate means that Out of 100 workers, 6 of them are expected to be unemployed and are currently looking for work. It's a measure of the overall strength of an economy, and it can be used to compare between countries. So it's another very important metric that we look at. So if you did enjoy the video today, please do leave us a like and subscribe to the channel. Any questions, comments, or requests, please do put those in the comments section. And thank you for your view today. We greatly appreciate it. And as we said, please do like and subscribe the channel, and we will see you next time.